Chapter 6. We continue with product costing and service costing. So we've talked about cost volume profit analysis, CVP analysis, and we've talked about fixed cost versus variable costs. Now we extend those concepts to a multitude of different business conditions. A good cost management system will be oriented to the needs of the decision makers. That means that the business is going to structure their cost system to give them information that they need. As you know, to prepare financial records for public companies, they have to be prepared on the GAAP method. But for cost accounting, there's no specific strict set of rules on how your books and records need to look. So since cost accounting records are used internally, there's more flexibility in how they look, and so they can be adjusted to meet the needs of the business. Another important aspect of a cost management system is that benefits need to exceed the cost. So what does that mean? That means that keeping books and records is a cost to the company. You have to hire accountants, bookkeepers that work for the company, and you probably also have to hire an outside accountant, perhaps an outside tax return preparer. So again, any type of accounting work that a business has to perform is going to cost the business money. And that's the same thing with cost accounting. Cost accounting reports is going to cost the business time and money. So the cost accounting system has to be designed in such a way that it provides important information, but the benefits to that information should not exceed the cost to get that information. Having a good cost management system is essential in decision making. Without accurate information, you also can't make intelligent decisions. So for example, deciding what to sell, if you have two different products that your company produces, you need to be able to tell which of these products is more profitable, which ones can be more quickly created, so that you can focus your time and attention and energy and resources to the more profitable product. And you can't do that without having accurate information to base your decision off of. Same for setting prices. Prices are determined by the market, not necessarily how much something costs. So let's say you're not a really good artist, so it takes you a lot of time and effort and energy and money to create a certain painting, whereas someone who is a much better artist can create a similar work of art much quicker and cheaper and better quality. So it costs you way more time and money to create the art than the other person, but the other person's art is way better. So does that mean that you can sell your art for more money? No, you can't. The market isn't going to pay for your art when it can pay for the other person's art that is a much better product. So that goes to show that costs don't necessarily dictate how much you can sell an item for. The market determines how much you can sell an item for. But you do need to know what your costs are, because you need to know whether or not you can turn a profit. So that's why cost accounting is important in setting prices. So here's an example of the type of questions we're going to see in this chapter. On this slide, we have two different types of products, alpha and beta. And we have three different cost pools: direct materials, direct labor, and manufacturing overhead. Direct materials is easy to allocate because, as the term suggests, the materials are directly traceable to the certain product or service. Same for direct labor. You can trace the direct labor to the certain product and or object. But manufacturing overhead, as you know by now, that's more difficult to trace. It's an indirect type of cost. So this chapter, we're going to see different ways on how we allocate overhead. In this example, it says that we're going to allocate it by direct labor cost. What that means is that whatever the dollar amount of cost we incur for direct labor for each product, we're also going to allocate a certain amount of manufacturing overhead to that product. Here's an equation that should look fairly familiar to you. This is how costs move through the inventories. They call it the basic cost flow model. but really it's just another iteration of the cost of goods sold equation that we've used in the prior chapters. So remember that in prior chapters we did beginning inventory plus purchases minus cost of goods sold equals ending balance. And so that's the same thing that we have here with just slightly different terminology. We have beginning balance plus transfers in minus transfers out equals ending balance. So it's the same formula, but with slightly different terminology and a slightly different application. So the cost of goods equation that we've been using is used for finished goods when we're selling the finished goods or the inventory that we purchased. With this equation, we use this for raw materials mostly and also for work in process. But the concepts are exactly the same. Transfers in is the same thing as purchases. Transfers out is going to be the same thing as cost of goods sold. We can rearrange our equations. So even for this first one, instead of beginning inventory plus purchases minus cost of goods sold equals ending balance, we can rearrange it to say beginning inventory plus purchases minus ending balance equals cost of goods sold. You just had to add positive cost of goods sold to both sides to move the cost of goods sold number over to the right, and then subtract ending balance from both sides to get negative ending balance to the left side of the equation. Here's an example. Miller Paints begins production on April 1st. They start and complete production of 100,000 gallons of paint. So this is something that we have to pay attention to. In prior chapters, we really didn't have to worry about equivalent units or partial units when we built something or an item in a month. We finished it that same month. Now we have to start paying attention to whether or not that's true. So in this case, we started 100,000 gallons of paint, and we also completed 100,000 gallons of paint. And we had no ending work in process inventory. Since we had no ending work in process inventory, that indicates that we finished all of the gallons of paint. And for cost, we incurred 400 grand of materials, 100 grand of labor, and 500 grand of overhead for a total cost of $1 million. So if we apply the number of gallons to the cost flow model, we're going to have transfers in of 100,000 gallons and transfers out of 100,000 gallons. Again, we know that we're transferring out 100,000 gallons because as soon as an item is finished, it's no longer in work in process. It's automatically transferred to finished goods. And so since the fact pattern told us that these 100,000 gallons were finished, we know that we're going to transfer out those 100,000 gallons to finished goods. And so what are the costs at the end of the period and how do we allocate it? We incurred $1 million of cost, as the fact pattern tells us, and we produced 100,000 gallons of paint, and those 100,000 gallons of paint were completely manufactured, 100%. So if you do 1 million divided by 100,000 gallons, you get $10 per gallon. Now for year 2, we have slightly different facts. We still have 0 beginning inventory, which is nice. It makes things a little bit easier. But here's a curveball. We started 100,000 gallons of paint for this month, but our ending work in process had 20,000 gallons. So we know that we started 110,000 gallons and 20,000 of those were not complete. They were only 50% complete. So that means that we must have finished 90,000, because if we started 110 and we still have 20,000 gallons sitting in work in process, that means that the other 90,000 must have been complete. So the way I like to envision a question like this is I envision that the paint company has 110,000 empty paint cans to begin the month. We filled up 90,000 paint cans all the way, and then the other 20,000 paint cans we only filled up halfway. So in this fact pattern, it tells us that we only filled them up halfway. Now, it's not always going to be like that. We are going to see some questions where maybe the cans are only filled up a quarter of the way or 80% of the way. Whatever it is, we have to pay attention to that figure. So applying the formula that we saw earlier, again, we started 110,000 gallons. So imagine 110,000 empty paint cans. We filled up 90,000 of those paint cans. And so we have 20,000 paint cans left. But these paint cans aren't full, they're only 50% full. So some companies will put down that they have 20,000 gallons of paint that are half finished in work in process inventory. But it's also helpful to present that same information in a different format. And so we calculate the equivalent units, the equivalent gallons of paint in the situation. So if you have 20,000 gallons that are only half finished, that's the same, or that's the equivalent of saying that they did 10,000 gallons that are 100% finished. So if you imagine 20,000 paint cans that are half finished, you could take all that paint and consolidate it into just 10,000 paint cans instead of the 20. So once we do that calculation, we see that we did produce the same as last month because we produced 90,000 complete gallons, and then we produced 10,000 equivalent gallons because remember, that's going to be 20,000 gallons times 50%, so we get 10,000 equivalent gallons of finished paint. So our total is going to be 90,000 plus 10,000 to get 100,000 gallons of paint. So actually, we produced the same amount of paint in equivalent units as we did last month. The difference is last month we produced 100,000 gallons of paint, sealed them up, and completed them, whereas in this case we produced only 90,000 complete gallons and then 20,000 gallons half complete. So why would we do that? Why would a company produce 20,000 gallons of paint only half finished instead of just finishing 10,000 gallons 100% of the way? Well, it could be a number of reasons. It could be that they're making different colors of paint. It could be that they're making different levels of quality, different brands. There could be a number of reasons. Remember that anytime we're doing accounting, it's not necessarily going to reflect every single piece of information about a product or service. And since this is just an example, they're also not going to give us a ton of details. But a question like that is a good question to have in real life. If you are working for a paint company in the future and you see something like this, you might ask the question, why don't we just produce 10,000 complete gallons of paint rather than 20,000 gallons that are only half complete? That would be a good question to ask. The example continues. Now again, this month and the prior month, we produced 100,000 equivalent gallons. But in this month, our materials is actually a little bit cheaper. We paid $390,000 for materials instead of the $400,000. So when we take the total cost and we divide that by the 100,000 equivalent gallons, our cost is $9.90 per gallon instead of $10 per gallon from the prior month. And so how do we allocate these costs? Well, for finished goods, we know that we finished 90,000 gallons. So 90,000 times $9.90 is going to give us $891,000. And then in work in process, remember that we have 20,000 paint cans sitting in work in process, but we don't multiply by 20,000 gallons here. We multiply by the equivalent number of gallons. And so the equivalent number of gallons is 10,000 gallons. 10,000 times the 990 is going to give us $99,000. And when you add 891 and 99,000, we're going to get 990. Here's another example. We have a furniture making company, and they're making two different types of desks. They have the S72 model and the S66 model. And again, we have direct materials, direct labor, and manufacturing overhead. And in this case, we're going to allocate the overhead based on hours, based on direct labor hours. This slide tells us that we produced 80 units of the 72s and 240 units of the 66s. Here's a typo. This should have said 72 instead of 27. And so it gives us our direct materials cost, which total $76,000. It gives us our direct labor cost, which totals $150. And then we have this manufacturing overhead of $252, but we need to allocate that. So how do we allocate overhead? Usually there's going to be a predetermined overhead rate. The rate is going to be a cost per unit, either given to us in a dollar amount or a percentage. So to calculate the overhead rate, we take our total overhead in dollars, what we estimated, and we divide that by the allocation base. Remember that the allocation base can be a number of things. It could be direct labor hours, it could be direct labor cost, it could be number of units, it can be a lot of different things. One thing that the slide points out is we're using estimates. Remember that cost accounting is forward-looking. We compare that to financial accounting, which we're always looking at the past, but cost accounting we use for budgeting and for planning. So we have to estimate costs so we can make decisions, and hopefully those costs are going to be pretty accurate, and then we have to compare them at the end of the month or the period to figure out whether or not our estimates were good, and then we might adjust our estimating practices accordingly to make better estimates in the future. So for this question, to calculate the predetermined overhead rate, we take the estimated overhead costs of $252. We're going to allocate it based on direct labor hours. So it's going to be $252 divided by 6,300 labor hours. And so we get $40 per direct labor hour. So what does that mean? That means that anytime we allocate a direct labor hour cost to a product, we're also going to allocate $40 of overhead to that product. So for the S72s, for the reporting period, we had 2,400 direct labor hours for this line. So we're going to multiply that by $40 of direct labor overhead to get your $96,000 of overhead allocated. And for the 66-inch line, it incurred 3,900 direct labor hours. So we're going to multiply 3,900 times the 40-hour predetermined overhead rate to get 156. And so to check your work, if you take the 96,000 plus the 156,000, you get your 252,000 manufacturing overhead total. And so here's our updated table. For the S72 line, we have our direct materials of 40, direct labor of 72, and manufacturing overhead of 96. So now we have total cost of 208. We take 208 divided by the 80 units produced, and that's how we get $2,600 per unit. And the same process for the 66-inch line. We add our direct materials of 36, our direct labor of 78, and our manufacturing overhead of 156 to get 270 total. Divide that by the number of units, and we get $1,125 per unit. So how does a company choose what allocation base to use? How do they choose whether to use direct labor hours or direct labor cost or materials? Well, as the slide says, it's somewhat arbitrary, but in real life there's a number of different issues to consider. Perhaps if overhead is more of a labor type of cost, then they might tie it to direct labor. If it's more materials based, they might tie it to direct materials. Or maybe it's just a function of how their accounting system works. Maybe direct labor hours are easily traceable, and so it's easier for them to apply manufacturing overhead to direct labor hours. So there could be a number of reasons why an allocation base is chosen. And as we've mentioned in the past, an allocation rate can either be a dollar amount. So like in the previous example, we were allocating $40 of overhead to the product based on direct labor hours, but you can also apply it as a percentage. So in this case, if you're using direct labor cost as the allocation base, and so you're taking the total cost in dollars divided by the total manufacturing overhead cost, you know that when you divide a dollar by a dollar, then that eliminates the dollar, and you're left with just a raw number. So if you divide $252,000 by $150,000, your answer cannot be in dollars. Your answer is going to be just a raw number. And in this case, the number is 168%. Here's what the table looks like if we allocated manufacturing overhead based on a percentage of direct labor cost instead of direct labor hours. So our direct materials is the same amount, direct labor is the same as well. Manufacturing overhead is going to be calculated by taking direct labor hours, 72,000 times 168. So we do 72,000 times 1.68, and we get 120,960, which we find here. And we can do the same calculation for the S66 line, $78,000 in direct labor cost times 1.68, and we get the 131,040. And so you add these two up, 129.60 plus 131.040, and we get 252. So it's always good to check your work after doing the allocations. Sometimes there can be multiple steps to these allocations. In this example, they took the overall manufacturing overhead, then they divided it into machine-related cost and direct labor-related cost. Then they decided that machine-related cost is probably more directly related to machine hours, so they allocate machine-related cost based on machine hours, and then for the direct labor-related cost, they allocate it based on the direct labor hours. So some questions can have multiple layers like this one. And so in this case, they found that the $252,000 in overall overhead can be split into $100,800 machine-related cost and $151,200 in labor-related cost. And so now they've updated this table. So here's your machine-related cost of $100,800 that we saw on the previous slide, and your total labor-related overhead cost of $151,200. Again, we check our work. We see that these two numbers total the $252. Now in this case, the machine-related cost, we're going to allocate it at $18 per machine hour, and labor-related cost is being allocated at $24 per direct labor hour. So we do the math there, and we check our work at the end. We make sure that the amounts allocated to the individual product lines equals the total, and it looks like they do. And finally, there are different product costing systems. You have a job costing system that's more applicable to certain types of industries, like in this case they say custom homes or movies or services. So each of these jobs are going to have enough differences that it doesn't really make sense to apply costs based on a repetitive process, because these types of jobs don't have enough repetition to be able to effectively track costs in that method. You compare that to a process costing system, and they say that's something like a cornflakes plant or a facial tissue plant or a paint manufacturer. These types of manufacturers, they do have repetitive processes, so the best way to track these costs is not by per box of cornflakes or box of facial tissue. The best way to track these costs are going to be by keeping an eye on the overall process of making these products. These products are going to be identical, and so it doesn't really make sense to look at each individual, and instead we're going to look at the process. And then you can have a hybrid type of business, and they're going to call it operations costing. And the examples they give here are automobiles, computers, and clothing, where when you produce these items, a lot of those components are going to be mass produced, like let's say for automobiles, the batteries or the tires. Those types of items are generally produced on an assembly line, and multiple of the same product or duplicates of the product are made. But at the same time, an automobile can have customization, and so that's more akin to the job costing process. And so in a business like that, you might track some costs using process costing and then other costs using job costing. So that's the end of the Chapter 6 lecture. Now on to the homework.